In this lesson, we will be discussing trading psychology as well as the necessary mindset needed to be successful in trading. Before delving into the mindset needed to be successful in trading, it is important to remember that the consistently successful trader that you want to be does not exist just yet. For this trader to exist, you will need to create an entire new version of yourself in the same way a sculptor creates a likeness of a model. With this being said, to make money consistently in financial markets, you will need to first not only acquire, but master certain mental skills. So, how can we do this? What factors must we understand? The utmost important factor in trading is your ability to control your emotions, and if possible, remove the emotional aspect altogether. Where this emotional aspect is strongest is when you have unrealistic goals for your trades. To be successful in trading, you have to be realistic about your expectations. Oversizing your position in hopes of hitting a home run will not only leave you emotionally exhausted, but you are more than likely to blow an entire account quicker than you would expect. The degree by which you know, assume you know, or in any way need to know what is going to happen next is equal to the degree to which you will fail as a trader. Mark Douglas. Let's be real. There isn't any trade out there that will undoubtedly go the way that you expect it to. This is the exact reason why you need to have a plan before you enter any trade at all. And within that plan, it should be detailed when you are going to enter, where you will take profit at, and when you will cut losses in the event that the move does not occur in the direction that you anticipated. With rigid rules that you follow to a T, you can entirely remove the emotional aspect from trading because instead of making decisions based on your emotions, you are making decisions based on a plan that you have created when your emotions were not involved. Every moment in the market is unique, and one thing that you cannot have is rigid expectations for the outcome of a trade. Follow rigid rules and have flexible expectations. Do not have flexible rules with rigid expectations. Having rigid expectations in trading will almost certainly lead to your failure as a trader, as you would no longer be using proper judgment to make decisions, but rather you would be making trades with the sole hope that it will go the way that you expect it to. The market does not care about your feelings or your finances. Hoping for an outcome to occur with no plan will inevitably result in the destruction of your portfolio, as you are essentially gambling at that point. And even if the outcome does happen as you expect it to, you will be left emotionally exhausted and unable to make proper decisions on your trades in the future. Also, by sticking to a rigid plan for each and every trade, you will avoid micromanaging trades. The concept of micromanaging trades involves changing the plan of a trade midway through. Changing the plan midway through generally results in two outcomes. Either you sell the position too soon before the move can fully develop, or you hold onto the position for too long, far past the move has already developed, both resulting in less gains and more losses. It is rare that micromanaging trades results in better outcomes than the original plan, because micromanaging trades is generally catalyzed by emotions that evolve from watching a stock too intensely, causing either greed or fear to set in, which, as we know, do not mix well with trading. Micromanaging in trades also occurs when a trader scales down to a lower time frame, one that was not used to write their original plan, and they see something that causes them to think something adverse may actually happen. But since they reduce the time frame to come up to this conclusion, it is generally incorrect, since they are looking at something on a more micro level that will likely not have a greater effect on the overall development of the trade. When in doubt, zoom out and use a longer time frame. It is almost never a strong idea to use a shorter time frame to make a decision on a trade where you drew up a plan using a longer time frame. There is actually a quite good tactic to combat against the act of micromanaging trades. The name of this method is called the Walmart trade plan, and it actually entirely removes the emotional aspect from a trade. How this works is you write out a plan for a trade, execute the trade with a stop loss and take profit. After you set the necessary parts of your trade, go to Walmart, shop around for a little, and after you finish shopping and go home, check to see how the trade did. If it won, and if it lost, it lost. But this will restrict you from staring at the screen the entire time and watching the trade move, which in fact also does restrict you from being able to micromanage the trade. The outcome of the trade is then solely based on the strength of your plan, and if your plan has a strong edge, then over time, this Walmart trade plan will result in a consistent growth in your portfolio. Now, you might be wondering what a strong edge means in terms of a trading plan. Simply put, a trading edge is something that a trader can identify about their strategy that gives them an advantage in the market. A strong trading edge creates a positive expectancy over a long period of time, as if the edge provides for success over 50% of the time, then in the long run, the trader will be profitable. That is, of course, if the wins are greater than their losses. A trading edge also allows a trader to go from being a player in the casino to being the casino themselves. It gives them favorable outcomes that puts the odds in their favor. As we have mentioned, not every trade will go as expected, even if the setup seems ever so perfect. But with a trading edge that has been proven to work, over the long run, a trader can have a positive expectancy. A trading edge requires a trade setup that has a high win rate or makes more money than you put at risk. In the last lesson, we mentioned how we are generally looking to make trades with 1 to 2 risk-reward ratios and ideally 1 to 3 risk-to-reward ratios. Being that both of these allow for more money to be made than is at risk, in the long run, if you only take trades with risk-to-reward ratios of this sort, then you will have a positive expectancy and likely be successful as a trader. Now, you may be wondering how you can develop your trading edge. Well, there is a couple steps to this process. The first would be to learn different trading setups. This is going to involve a lot of research on market patterns and movements to understand what is likely to happen when a certain pattern takes place. Once you find a setup that works for you, you can start practicing how you would play these setups by using a paper trading account or a demo account. This will give you a strong idea of how to play this specific setup when the time comes to using real money. In your practice, you will need to identify the time frame that you are going to use, the point where you will enter at, where an appropriate stop loss will be that you will stick to no matter what, and potentially most important, where you are going to take profits, looking for that ideal risk to reward ratio or better. We will go over how to do all of this in the next module. Anyway, test this strategy out to a point where you are certain about its potential. Once you master the setup, you can apply it to your trading, and just like that, you have developed a trading edge. It is important to understand that there are no shortcuts to developing a trading edge, and the most important factor toward a successful trading edge is practicing it until mastery. Remember, practice does not make perfect, but rather practice makes permanent. This means that if you are practicing it incorrectly and making the same mistakes over and over again, you will continue to make those same mistakes when it comes time to trading in the market. If you see that your strategy is not working, adjust it before it is too late and you get used to making decisions in one way over a stronger way that would allow for more success. Also, if you have proven that your trading edge works, remember to trust it within your plan and do not let emotions take over your trading, as that will remove your edge altogether. If it was proven to work, why try to fight against it during a trade? I would highly recommend reading the book Trading in the Zone by Mark Douglas, as it is incredible for understanding the mentality needed for trading and becoming a successful trader. Let's go through some of the major points made in this book and compare them to what we have already mentioned. In his book, Mark Douglas speaks about the 7 beliefs to form consistency. First, you must objectively identify your edges. As we have just mentioned, Edges are paramount to being successful in the long run, as an edge is what provides a trader with positive expectancy. Next, the risk to every trade must be predefined. This means that you must completely understand exactly how much you can potentially lose if things do not go as you may expect. This is why we heavily stress the importance of identifying the risk to reward any trade has. He then mentions that you must completely accept the risk and that you are willing to let go of a trade. In short, this means that you must accept your plan and follow it without letting emotions sway your predetermined exit points. The next belief is that you act on your edges without reservation or hesitation. As mentioned earlier in this lesson, if your edge is proven to work, hesitating will only hinder you from entering a trade that you know is favorable to you. Hesitation comes from fear, fear of being wrong, and fear of failure. Hesitating to act on something you know works with a positive expectancy will only reduce your confidence and keep you from being successful using the tools that you know work. If you hesitate or justify jumping the gun in incorrect situations, you will not be able to trust yourself going forward. And as we know, consistency and having a strong mindset in the market is a byproduct of trusting in your skills and being confident in the rules that you have made for every single trade. Thus, acting on your own interests rather than trusting yourself to be objective will only hinder your ability to achieve consistent results. The fifth belief to form consistency is paying yourself as the market makes money available to you. This essentially comes down to setting aside profit as it comes. If you do not pay yourself when money is made available to you, then are you really making money in the market? Continuously monitoring your susceptibility for making errors will keep you honest in the market. As you remember from the quote at the beginning of this lesson, the more you think you know goes hand in hand with how likely you are to fail as a trader. You must be honest with yourself and truly understand that you are not perfect and no one will be correct 100% of the time. Accept the risk of a trade, and if your conviction is incorrect, let go of the trade before it is too late. And finally, these principles must be understood as being necessary for consistent success. Consistent success does not come from luck, but rather through rigid rules and flexible expectations that we previously mentioned. And if you understand the level of utmost importance that these principles have, you will also understand that violating these principles will keep you from being the successful trader that you want to become. Moving forward, Mark Douglas preaches the importance of taking responsibility. You must develop restraint to making decisions based on your personal interest, as attitude and perspective produce better overall results than any analysis or technique can. Your lack of market knowledge is not what is holding you back, it is your perspective about the market. The solutions are in your mind rather than in the market. Believe in the uncertainty in the market. We have honed in so greatly on the fact that anything in the market can happen and nothing is for sure going to happen. There are only probabilities of an event happening and the likelihood of one event happening over another. This comes down to understanding the risk you are taking with every trade. Nothing is certain. What you can be certain about is that playing events that have probable outcomes will produce consistent results. That is, of course, as if the odds are in your favor and your sample size is large enough. Then a positive expectancy in the long run will occur. Each and every trade is unique. Therefore, each trade is independent from any other trade that you may have had. Solely because it happened in the past does not mean that it will certainly happen again on a specific trade. It simply means that it is likely to occur, and you can use those probabilities of likelihood to form an edge that gives you consistent results over time. Mark Douglas touches on the 5 fundamental truths about the financial market. The first of these truths is that anything can happen. There is no rigid expectation for any setup, no matter how perfect it looks. Each and every trade is independent from each other, and understanding this fact will build your perspective on how to trade in the market successfully. The next truth is that you do not need to know what is going to happen next in order to make money. You do not have to be certain about any setup in the market. As long as you make trades based on what is likely to happen, then you can make money in the market. Trade your edge over anything. With that being said, the next truth is that there is a random distribution between wins and losses for any given set of variables that define an edge. The market is random. There are no edges that are perfect. You need to understand this, and it may sound redundant at this point, but we cannot stress enough that everything in the market is only probabilities where time will tell if those probabilities play out the way that you may expect them to. That brings us to the next truth that an edge is nothing more than an indication of a higher probability of one thing happening over another. And finally, the last fundamental truth is that every moment in the market is unique. Once you understand and accept these 5 fundamental truths of trading, you will fully be able to grasp what is necessary for you to be successful in the market. These truths will set up the foundation for the development of the necessary mindset and perspective for trading in financial markets. You will take losses in the market, but do not let those losses destroy your confidence. Mark Douglas puts this quite well and states that losses are the amount of money I need to spend to make myself available for the winning trades. No one will be correct all of the time. Losses will happen. All that matters is that you are correct more times than you are wrong, or that your winners are far larger than your losses. So with all of that being said, how does one fully develop a trading mindset? Mark Douglas breaks this down into 3 stages of development. The first stage is mechanical, where you build that self-trust and confidence that you need to operate in an unlimited environment. You will also need to learn how to execute your trading system to a T. Do not stray away from it, and if there are errors in the system that can be objectively defined, make those corrections on the overall system, not on individual trades. By doing this, you can create a strong, unshakable belief in your consistency as a trader. The second stage is the subjective stage, where you use what you have learned about market movements to decide what you want to do. The choice is yours, and deciding what to do through what you have learned over and over will move your knowledge from the conscious to the subconscious part of your brain, where you can do things intuitively. Which brings us to the final stage of developing a trader mindset, which is to operate intuitively. Use what you know works and act on it in such a way that you are fully confident and instinctual with every decision you make in financial markets. To conclude not only this lesson, but the module as a whole, we have given you the necessary information about the fundamentals of trading, and the key takeaway from this lesson is that you can have the strongest trading edge in the world, but if you let your emotions control your trade, forcing you to stray away from your plan, then that trading edge means nothing. In the next module, we will go over technical analysis in depth and how you can use it to create a trading edge of your very own.